It says that oh, I just got a little, okay. It says that people are engaged, and I know we are, and more. So it's wonderful. And it's not only important to make statements and sign letters. We put a report together that puts our words into action. The market demand for sustainable finance is exponential at this point, and we want to be on the forefront of responding to these demands. This is where our CSR work most significantly meets our business strategy. This is how we put in action the notion of doing well and doing good. As a socially responsible institution, this work is core to our vision for economic, social, racial, and environmental justice. This is where our legacy, our history, and our relationships with small businesses, non-for-profits, philanthropies, social enterprises, and community development institutions gives us a real advantage in turning this vision into a real reality. Amalgamated is small enough to be agile and big enough to make an impact, mostly through influence with others. We continue to call on all the financial institutions to follow or to join us or to continue for those who've started. It's not an easy task, but there are reasons beyond curbing climate change that institutions should consider. First of all, the consumers are more and more moving in this direction. The interest and appetite that consumers have and will continue to have will be insatiable. We have to be in front of that. There's risk protection in this work, and it's important to understand what is happening and to be on the forefront again of making sure that we understand the risk and are helping our customers prepare for it. There's competitiveness internationally, and there's the need to support policies that move markets and bend the arc toward a more just and equitable economy. Leaning in on regulations that move us to a sustainable and just economy is critically important. I know that I'm preaching to the choir and that you've joined in because you're already aware of or ahead of this curve. And I hope that the numbers just continue to grow. And I know you do too. So thank you for being here.
Thank you, Priscilla. It's a pleasure to have you here, and it really signals how important this really is to the bank. And that's an important signal.
It is.
I really appreciated your point about how this work is the intersection between all of the key issues of this time, between climate and racial equity, the wealth gap, that it exists at this really important nexus. Thank you for highlighting that. Next, we're going to turn the time over to Ivan Frishberg, who is a senior vice president with the bank and the chief sustainability officer at Amalgamated. And he's going to give us a little bit more detail on what's going on with the targets themselves and
Great.
How the bank's going about meeting them.
Thank you, Sarah Joy. If you want to put up the slides.
Absolutely.
Although you have this beautiful view in Glasgow behind me, but I think the real action is in the data. So, but as folks know, Amalgamated Bank for the last few years has been working to align our portfolio with the targets established by scientists originally at the Paris Climate Agreement and being reaffirmed here. And so we have worked with a lot of the people who are part of this conversation today, but through the UN, through the Science Based Targets Initiative. And so we're really excited that last Monday, we actually announced our climates formally and published them in accordance with the United Nations target setting guidance, and then also submitted those to the Science Based Targets Initiative. If you want to go to the next slide, one back.
Oh,
starts with science.
There we go.
Oh. This is really where we started. And this is which is to say it started with science. That we knew we needed an approach that was going to be driven by the reality of absolute emissions in our society and the world. What you see here is the IPCC scenario for aligning with 1.5 degree temperature outcome. You can see it requires basically an immediate peak of emissions. So we have to start sliding down the hill now. We very quickly have to start removing emissions beyond just mitigating the emissions that we have. And that really this is the pathway or some form of it that everybody in the world is going to have to accomplish. This is what governments are here in Glasgow committing to with their NDCs. This is what companies and non-state actors are doing with their targets. And really what we're presenting is sort of Amalgamated Bank's version of these targets. You go to the next slide. The reason, we take this seriously and that all folks take this seriously is because of the impacts. And I think we're also grounded in that. These are not just pictures from the Al Gore slide presentation. These are things that have happened within the last year. These are things that have happened that have impacted our customers and clients. This has impacted our employees. This is a very real issue as we know across the globe. It's not only happening now, but we know it's going to get worse. And so I think this, beyond the science, is sort of the other grounding, is the impact that we hope to avoid. Go to the next slide. Now we get into the really fun technical work here. I can't see the slides. Oh, here we go. So I'll go back one, I think. There we go. So the first piece about our targets is that to be able to do target setting, you need to be able to create a baseline for your emissions. And so we have been working at the leadership of the Partnership for Carbon Accounting Financials for quite some time to develop the methodology and the standard for measuring financed emissions. And so here we have the chart from our 2020 analysis that shows the full emissions from our portfolio of lending and investments. We disclose this publicly. We're part of a community of financial institutions that is doing this. And we did it because that kind of climate disclosure and transparency is important, but the real prize was getting to this target setting work. And now what we've sort of proceeded to do is take all the numbers you see in that scope 1, scope 2, and scope 3 category and start to plot them out by the different asset classes that we have. And you can start to see here where we have what are in the blue line, the dark blue lines, what the baseline scenario for 1.5 is, and then where we've modeled our portfolio and our growth over the coming really decades, both through a 2030 target and a 2050 target. And then when you put all of this together, this is where you come out with our kind of aggregate emissions portfolio trajectory. So if you go to the next slide, Sarah Joy, you can start to see represented both in the chart on the right, how those emissions taper down, and on the chart on the left, what that results as is in terms of carbon intensity. So the amount of carbon emissions per dollar of lending. We're really excited about the emissions intensity direction that we're headed in with this. But the real value here is being able to get to zero in 2045. The way we've done that, as I mentioned, is we have a scenario base case, which is the dark blue line. This is using IEA data specific to North America and the sectors that we're in. We then modeled our portfolio very directly to existing policies in our key jurisdictions. So in New York City or Washington, D.C., there are laws that clean up the grid, that are decarbonizing buildings. And so we've matched our portfolio to those policies, and it's allowed us to get to more significant emissions reductions in the near term. We know, though, that to keep doing that, we have to go beyond it. And so at the end of this process, starting in 2030, we're also planning on financing emission removals. primarily through technology-based emission removals. And when you put all that together, that gets to the light blue line, which is our emissions trajectory. The last 2 points I'll make is that there is incredible opportunity for the banking sector in doing this. We know now that there's globally $100 trillion of assets from the banking, investment management, investor ownership, and insurance side that have committed to net zero alignment. And so there are investors that are looking for aligned places to invest their money. And there are asset managers that are committing to make sure that their portfolios are aligned with net zero. And so we think that as a bank is an opportunity to be part of a community bringing down emissions. The other piece is that we have significant investments in the clean energy space. 23% of our portfolio is dedicated to climate solutions. And a significant portion of that is, Sarah Joy is mentioning, is also within it dedicated to racial equity and to closing the wealth gap. And more broadly in our portfolio, we see those priorities exist at significant levels as well. But we think this is a clear signal to clients that in the sustainability space that we are serious about these targets, that we've created a framework for them. And a framework for being the bank that serves the clean energy space and the sustainable finance space. So we're excited about what this means for the financial community, about the signal it sends to the folks here at the COP who really have to do the hard work in terms of making commitments real. And we're excited for what it means for our clients and other stakeholders. And so with that, I'll turn it over to you, Sarah, to start to go into the panel.
Wonderful. Thank you, Ivan. So we are really pleased to host a panel discussion next for the next several minutes with digging into some of the key issues surrounding this and going beyond just Amalgamated's targets into the industry as a whole. And in addition to Priscilla and Ivan, we have a few experts to introduce. Let me get Priscilla back on screen here. So Cynthia Cummis is the Director of Private Sector Climate Mitigation at WRI's Business Center. I have to find her, I apologize, so that I can get her on Spotlight. Oh, there, your video's on. I'm like, if you make sure your video's on. There we go. This is Cynthia. In this role, she leads the Institute's work with businesses to reduce greenhouse gas emissions, including the Science Based Targets Initiative, which she co-founded, and the GHG Protocol's suite of corporate GHG accounting and reporting standards. So Cynthia was formerly the Deputy Director of the GHG Protocol and led the development of the corporate Scope 3 accounting and reporting standards and the product life cycle, accounting and reporting standards. We also have Justina Gallegos, who was a former Obama administration appointee at the White House and Treasury Department, focused on fintech and cybersecurity policy, and then went on to be a general partner at an early stage VC, backing innovative founders launching early stage companies. And this spring, she returned to the White House as a senior advisor on the National Economic Council, focused on climate finance, as well, and is part of the team who most recently released the government-wide strategy, A Roadmap to Build a Climate Resilient Economy. Welcome, Justina. And finally, we have Pulang Tumelo Njuili Potele, who oversees the work on principles of responsible investing at the Banking Initiative lead within the United Nations Environment Program Finance Initiative. UNEP-FI is a unique United Nations partnership that focuses on the links between the finance and ESG challenges and the role that the financial institutions could play in a more sustainable world. So we have a great panel. I'm really excited for this discussion. So to start things off, let's start with some context, Pulang. You lead the Secretariat for the Net Zero Banking Alliance. how are the guidelines from that alliance connected to the Science-Based Targets Initiative?
Thanks, Sarah Joy. So I form part of the alliance that is the Secretariat. I form part of the Secretariat that looks after the Net Zero Banking Alliance. So maybe let's start with what is the Net Zero Banking Alliance, and then we'll go into the SBTI. So this is an alliance of 88 banks now that represent over 40% of the global banking industry, and they have all committed to align their portfolios with a 1.5-degree pathway by 2050. And what they are required to do in order to meet this overall target is to set sector-based targets. They need to focus on the most carbon-intensive sectors. They need to have interim targets. Those targets need to be based on set against a baseline. They need to have action plans, that detail how they're going to achieve those targets. They need to use science-based decarbonization scenarios, such as the IEA scenario and the IPCC scenario, and they need to conservatively use carbon offsets and carbon emissions removal technologies. And they need to report on all of this periodically. Now, the rigor coming to the guidelines, the rigor of this commitment really sits within these guidelines, the guidelines for climate target setting, which were developed by the Collective Commitment to Climate Action, which were really the first movers within UNEP-FI who first developed targets or who committed to set targets to align their portfolios with a less than 2-degree goal. And most of those banks have now signed up to the Net Zero Banking Alliance. So they developed these guidelines in order to make sure that targets would be underpinned by rigorous requirements or criteria. And so that's where these guidelines come from. And they were published alongside the launch of the Net Zero Banking Alliance back in April of this year. Now, when developing these guidelines, we thought it was important that, firstly, they are methodology agnostic, which then allows for flexibility of approach and methodology. But it was also important to ensure compatibility of these guidelines with other methodologies that are developed by other stakeholders, such as the SBTI. Thanks, Sarah. Joy.
Thank you, Puleng. And Cynthia, as one of the original proponents of SBTI, what do you wish more people understood about either science-based targets themselves or the process of setting science-based targets?
I think I'd like to talk about here just is provide clarity on what we see as what net zero means. Now that we have we launched a standard last week on net zero for companies, and that is going to inform a parallel process where we've embarked on now to develop a net zero standard for financial institutions. And the way we define net zero for a company is that companies all need to set near-term science-based targets. These long-term targets are meaningless without the near-term target that drives real accountability for near-term action. So companies have to set near-term SBTs, and then they have to set these long-term SBTs. And there's very little net in the net zero. Companies really need to be reducing their emissions 90 to 95% by 2050 or sooner. And then the only role for the netting is like in these permanent removals to balance any unabatable emissions at this state of net zero. We want to encourage companies to invest along the path to net zero and what we call beyond value chain mitigation. So a whole variety of mitigation activities that are out there to accelerate the transition. But this is all above and beyond their near-term and long-term science-based targets. So I like the direction that Amalgamated is going into, where they're thinking about what net zero looks like and focusing on emission reductions and removals within their portfolios, rather than looking outside to get to that point of net zero. I think that's the direction SBTI is heading, and we'll be putting out a paper next week that lays out like sort of a foundation of net zero for financial institutions, where we'll be seeking stakeholder input.
Thank you, Cynthia. Justina, you work on the National Economic Council report on climate financial risk that called climate risk a systemic risk that requires a precautionary approach. That's a really high bar when it, do science-based targets meet that challenge? And if so, how? And if not, what else do we need?
Sure, thanks, Sarah Joy. And I just want to take a minute to really underscore this point because it's important. So as you mentioned from our report, we know that climate change poses an ongoing, urgent, and really systemic risk to our economy and threatens our financial institutions, businesses, workers, and families. And we are really taking a precautionary approach and encourage the same from all parties, meaning that because of the seriousness and irreversible impacts following from climate tipping points, inaction is not an option for any party. And new strategies and approaches must be developed really across the board to address this challenge. And so even as we work to measure, assess, and disclose climate-related financial risk, we also need to mitigate the impact of climate change in real time. And so we know that every fraction of a degree of warming that can be prevented saves lives and economic cost. I'm sure this has already been discussed, and Ivan just mentioned this, but extreme weather has really upended our economy and affected 1 in 3 Americans this year. Wildfires have burned more than 6 million acres of land and destabilized our international supply chain, which we are all aware of. Over the past 5 years, wildfires, floods, and extreme heat and other events have cost Americans over $600 billion. And so protecting the American economy and financial system from risks and the impacts of climate change is really new territory for many governments. And our report that we just put out demonstrates how the US intends to take a leading role in addressing this issue head on. And so to your question, Sarah Joy, regarding the financial community, we are really looking to the findings of the recently released FSOC report for the actions that it will spur to further measure, assess, disclose, and ultimately mitigate climate-related risks for our financial system. And we also know that this work for financial institutions is really going to involve the necessary blending of what I like to think sort of traditionally siloed areas of climate and traditional finance in order to really help capital flow towards the fight against climate risks. Thank you.
Thank you, Justina. So Priscilla, we know that trust is a critical element of banking in general, but for a lot of people concerned about climate, it's a pretty thin commodity these days. Why should people trust banks to do what Justina just talked about and take that holistic approach and actually, move to meet these targets? Where's that trust going to come from?
Wow, that's an excellent question. And I have to give a little bit of a glib response. I mean, we have to trust because we have no other option. Financial institutions are such an important, part of this puzzle. As are many others. It's a thorny problem. We have, public and private trust that's required. We're all expected to trust in some way because many of the technologies and policies that are required to get us to the goals that we're setting have not even been done yet. I mean, they're not even completed, or they're still to be discovered. And so we're all taking a little bit of a leap of faith, aren't we? What we think is important, I think I'm preaching again to the choir on this call because everybody would likely feel this way if you're on this call. But we all think it's important to set the goals and then to the point earlier made, not just the longer term goals, but the glide path to getting there and the shorter term targets as well. And then you just keep pushing, and it's got to be done in scope 1. You can't leave it all to scope 3. And you've got to really make the commitment and bring it to life in every way with every partnership you have. In our case, with customers, in policy setting with governments and legislators, with partners of every kind, suppliers, you name it. So it's a hard question because I know that trust is low. We're at a point in our society where polarization exists in every way. But I think we all agree that we have to because we have no other choice. We don't have a lot of time to think it through. And it's just a matter of doing it now.
Thank you, Priscilla. I think there's a lot of truth in that. Now, if there's one topic that seems to stir up more controversy than others in this discussion, it's offsets. And we've heard from Ivan, I think he didn't harp on it, but I can harp on it a little bit, that Amalgamated doesn't use offsets in their net zero targets. And that's not a common position. What's your perspective on offsets and their role in net zero plans, Pauline?
So I think firstly, congratulations to Amalgamated on setting their first targets in line with their commitment to the Net Zero Banking Alliance. So I think it was Cynthia who said it. It's very clear that banks need to decarbonize their portfolios if we are to reach net zero. Now, if I reflect on what the guidelines that I was talking about earlier on say with regards to the use of offsets, they say that they need to be used very diligently, that the role of offsets is to supplement decarbonization in line with climate science, and the reliance of carbon offsetting for achieving end-state net zero should be restricted to carbon removals to balance residual emissions. So this should be in instances where there are limited technological and financially viable alternatives to eliminate emissions. And offsets should always be additional and certified. And lastly, banks should conduct appropriate due diligence on clients' offsetting claims.
Thank you. Cynthia, anything to add to that?
Yes. I think for companies, there is a role in investing in offsets as an additional way that they can, I don't know, compensate for their historical emissions and their unabated emissions on the path to net zero. But they can't be part of, you know, as I've already mentioned, offsets cannot be part of SBTs. This is like something we established very early on in the initiative, or we'll never hit a 1.5 degree pathway. But I get very concerned when I hear financial institutions discuss the purchase of offsets. They have so many opportunities to accelerate the transition through their core business activities. Why would they need to buy offsets? I just can't see a world in which that is a useful use of a good use of financial institutions' resources. But it all comes down to how we define net zero for financial institutions. Lots of them are setting these net zero targets, but there's not real clarity yet on what is a credible approach to meet those targets. And I think that's what I hope SBTI is going to help bring to the financial sector and provide more clarity on if there's any good use of offsets.
Thank you. Now, Ivan, I think we can all acknowledge that this isn't, you know, I guess you can't just snap your fingers and set credible targets. So there are perhaps some authentic barriers in this process for financial institutions. What do you see those as being? How do you perceive those in the financial industry? Where are the bottlenecks? What's keeping particularly the US financial institutions from moving forward in this process? You know, is it technical expertise? Is it ambition or economic will? Is it risk assessment? What are the barriers?
Sure, thanks, Sarah Joy. First of all, we know this is going to be incredibly difficult. We are now, even under the updated commitments being made here in Glasgow, we're on path for a 2.7 degree world, right? So we've already increased the temperature 1.1. So the pathway that we're doing is, you know, it's an incredibly steep reduction in emissions. It's an incredible transformation of our whole economy. And for financial institutions, that is a particular challenge because they have their clients, many of those who we don't, but many of those who are in the high carbon sectors who are in the middle of this, and they're just not ready. You know, there are oil and gas companies that talk about reducing emissions in operations, but aren't thinking about scope 3 emissions or reporting those. For financial institutions, they can try to engage with these companies, but ultimately they have to make hard decisions about reallocating capital away from those technologies and into sustainable technologies that are aligned with a 1.5 degree temperature outcome. So, but those are really difficult things to do inside a financial institution. We're also at a point where we don't have the policies. And I'm really glad that Priscilla brought this up, because, we have them. They're in papers and they're produced by think tanks, and they're just not being adopted by policymakers at the speed that we need. We are still supporting, essentially, with our policies, whether it's subsidies to certain industries or permitting, the lack of resources going into clean energy. All of those things don't really support the economic transition that private capital can then play a role in. So we have to do more on that policy side. I think from the US perspective, the agenda now, the Build Back Better agenda that President Biden has led, and the sort of what seems like Congress is poised to get that passed, that's going to be a huge shot in the arm here. It's not an all the way there piece, but it is historic, and it actually starts to become really essential to all of the banks that are going to have to align their emissions, that we have that kind of support from policymakers. So I think that's the other piece that it has not been there. That creates a real barrier. Banks can't go out and do this on their own. They need policy to build from. But both of those things are going to be, more needs to be done, and it will be challenging.
Thank you, Ivan. On a more hopeful note, Priscilla, I'd love to hear from you. What do you see as the next big thing on the horizon for financial institutions?
Look, I think we're going to continue to find new and creative ways to finance interesting technology that comes out of all of this. I think public opinion has shifted. We've turned a corner in that financial institutions can no longer escape the reality that we are the source of financing for what has to be the most important work to be done in the next decade. And we can't wait for it. So I think what's exciting for financial institutions is that public opinion and just the evidence of climate that we have all seen in the last year or two. I just spent the last 2 years in Australia, and we certainly have seen, for example, the worst of bushfires and drought and flood, and then COVID. And while all of this is not attributed to climate, certainly climate impact has had an impact on these events. And so this natural period, this tipping point that we've hit, is causing financial institutions around the globe to take note and have to do things differently. And to Ivan's earlier point, many customers are not ready, but financial institutions can be proactive in helping them get there. And I think that's starting to happen as well. So I'm very optimistic that the financial marketplace will start to reflect, and actually you'll see premiums where people have taken the right approach and think about doing well and doing good.
Excellent. Justina, for you, what gives you the most hope when it comes to financial institutions and their role in a more sustainable future?
Sure. So we touched previously on climate finance risks, but as mentioned, climate change also presents historic economic opportunities. And this is a really exciting moment. At the UN General Assembly, the president recently announced his intention to work with Congress to quadruple our climate financing, including support for adaptation. And as you mentioned, we are also on the cusp of an unprecedented investment to defeat climate change, and these deals combined will be the biggest effort of its kind in history. And so the Build Back Better Act will create millions of good paying jobs, enable more Americans to join and remain in the labor force, spur long-term economic growth, reduce price pressures, and set the US on a course to meet our clean energy ambitions. It would also ensure that we can meet our goal of reducing greenhouse gas emissions between 50 and 52% below 2005 levels by the year 2030. And so these investments would include historic funding, including I'm looking at 300 billion for clean energy tax credits, over 100 billion for resilience investments, over 100 billion for investments in incentives for clean energy tech, manufacturing, supply chain innovation, 20 billion for clean energy procurement, and we're really just getting started. The president has been clear that investments that we make to combat climate change, including those investments proposed in the Build Back Better package, must be catalytic. And so these investments would bring private capital really off the sidelines and directly into the projects that we need to mitigate the impacts of climate change. And so this is a really exciting moment, and we look forward to the work ahead, which is momentous in this history-making opportunity. So thank you.
Thank you to all of our panelists. And we have one final question that we'll close out the event with, but we're going to turn time over for some questions from our participants. But I'll give you a preview of what that question is going to be. We'll have each of our panelists respond to the question. If you could wave a magic wand and change one thing about what the financial sector believes or understands, or how they react or how they engage with climate change and the energy transition, what would it be? So we'll transition to that at the very end of our discussion, and you'll get to hear what each of our panelists have to say about that. For now, we're turning the reins over to you and would love to hear your questions. So use the raise your hand function or put your questions in the chat, and we will get to the expertise of our illustrious panel on all of those queries that you have. Maybe you all didn't expect to be able to interact. While you're thinking of your questions, oh, here we go, we've got one. What do you think is the best way to popularize the no offset approach for other banks?
I will jump in on this one. I think this is where I'll speak for Cynthia. Maybe I think this is where the standard setters become really important, whether it's the net zero guidelines or whether it's SBTI. I think you were watching Secretary General Guterres' opening comments today. He talked about a really exciting new panel under the UN that's going to be set up to evaluate and hold accountable non-state net zero commitments. I think that is where the rigor has to come from. And then I think if there are clear standards and benchmarks, the industry obviously is pretty good at meeting those.
Do you want me to add? Can I add to that?
All right, Cynthia.
Yeah, I would. Yeah, I agree. It's the standard setters and these initiatives that are out there. I think GFANZ obviously has a, and the Bankers Net Zero Alliance as part of GFANZ has a lot of influence over what the banks are going to do to meet their net zero targets. So for GFANZ to come out and say that net zero is not a good way to, that offsets are not a good way to meet these net zero targets, that would be really useful. Just like the Race to Zero has these meta criteria that we, for evaluating the different net zero initiatives, and they're in those criteria, they make it clear that offsets should be used to meet these science-based targets.
Excellent, thank you. We'll hear a couple of your magic wand responses while we're gathering other questions. Pulang, let's start with you.
Sorry, just took me a moment to get unmuted. I'm already quite encouraged by what I'm seeing in the banking industry. As said, we now have 88 banks globally that have signed up to the Net Zero Banking Alliance, and there's many more who are building capacity to join. So I think we are really going in the right direction. So what more would I want to see? I want to see more banks making these bold commitments and then obviously delivering on them. That's the important part, right? Actually setting those concrete targets and doing that as soon as they possibly can. And I also want to see banks starting to consider related impacts as they're setting their climate targets. So, what about deforestation, for example? Can we be addressing that as well? Can we be looking at human rights issues? So to start to look at the different impacts that they have across their portfolio in a very interconnected way.
Thank you. And I think both Cynthia and Ivan, this next question will tie into your magic wands, if I understand them correctly. Does Amalgamated foresee having to divest from certain clients not moving quickly enough to decarbonize? And either Priscilla or Ivan, that sounds like a question for you.
Yeah. Do you want me to get that, or do you want
Go
to
ahead, Ivan, and I'll. Sure.
We are fortunate because many years ago, we set values-based criteria in our credit policy. So it's not a forward-looking thing as much as us, it's a sort of a backward-looking thing. But I think that has been intentional, not just from a climate perspective, but from how we see the world and who we want to benefit. So we have policies against all sorts of things, private prisons, fossil fuels, there's a bunch. But I do think that is ultimately how it's going to have to go for the financial sector. And the words I used earlier were about reallocating capital away from technologies. This isn't saying you have to divest from Exxon, but this is about putting very specific terms in place to say, these are the technologies that we are not going to have our capital associated with. You can transition fully, or you can, but to get our capital, here's the rules you have to play by. And I do think that's people call it divestment, and it is that, and that's a controversial world in the financial industry. But that is the reality: is we do have to reallocate capital away from certain technologies.
Cynthia.
I think engagement should always be the first approach, that financial institutions should engage with their clients to influence and support them to transition. But if the client for some reason can't or won't make that transition, then they have to consider divesting at that point. Yes.
Anything to add, Priscilla?
No, I agree with those statements. Nothing to add.
Great. So Justina, if you could wave a magic wand and change anything about the financial sector, what would it be? Well, regarding climate change.
Sure. Thanks, Sarah Joy. If this year has really shown us anything, it's that climate change poses just a systemic risk to our economy and really the livelihoods of everyday Americans. And we have to act now to address these risks. And as the president always reminds, though, climate change also presents this generational opportunity. And I want to take a moment to really talk about our approach, which we hope can serve as an example for others. And so by tackling the climate crisis head on, we can spur the creation of good paying jobs, protect the life savings of workers and families, and ensure long-term US economic prosperity. And so the belief that climate offers a once in a generation chance for job creation and innovation is what underpins the president's entire economic strategy. And that really means that with the right policies, the president knows that we can drive a net zero transition that is orderly, timely, and importantly, a driver of inclusive economic growth. But achieving this will really require a renewed relationship between the public and private sector, one in which the federal government can tap into the full force and potential of private markets while driving capital towards optimal investment outcomes. And so really to that end, the government is pursuing an industrial strategy fit for the 21st century, taking on a more elevated and concerted role across a number of key areas that I just want to highlight. This includes really jumpstarting public domestic investment as a share of our economy. This includes major investments in research, development, deployment of clean energy, in infrastructure networks, and in the nation's workforce. Also, the US federal government alone spends over $600 billion in contracts each year. And while we know that procurement alone won't single-handedly decarbonize our economy, it is really primed for pulling forward demand for products in a way that facilitates broader and quicker commercialization. I could speak to examples if you're interested. And finally, we are situating equity as a top priority in all of our policy-making decisions. To really maximize the country's full strength and potential, we have to leverage the talent and creativity of all Americans, regardless of background. And so we really believe that tackling these challenges together is the key to growth, and we hope that inspires others to take that same approach as well.
Thank you, Justina. Ivan, how about you? What would you do with your magic wand?
Well, I was going to first talk about keeping it in the ground and stopping all fossil fuel expansion so that we have a real fighting chance. But I actually, listening to the COP, some of the opening speeches this morning were peppered with speeches from young people. And for those who are parents, you hold two things in your life, right? You hold sort of a kind of uncrushable optimism about your own kids, and you fear everything about your own kids, and you will do anything to protect them. And so you kind of carry those two balances at the same time. So I would want, sort of inside the financial industry, everybody who's making these decisions along the way on this path to net zero, not to be thinking of their own children. Because I think along with that fear, and which should be motivation, they're also going to have that optimism. But I would ask them to think about the other people's children and future generations and the kids in developing economies that don't have the resources that we do, and think about that as sort of the inspiration for what really needs to be accomplished. Because I think it's what we're going to do is really hard, and it will require incredible capacity and technology and the brilliance of people inside the financial industry, but it's going to require an incredible amount of bravery and heart and values to be able to get us there.
Myself. We have one last question from our audience, and then we'll close out with Priscilla's magic wand. So this is an interesting one, I think. If unproven and speculative climate solutions become widely embraced by the financial sector, or by the banking sector specifically, does that then become a source of systemic risk on its own? It's an interesting question.
Very interesting question. Just to break the silence. What I can say to that is that, I said earlier on, Net Zero Banking Alliance now represents just over 40% of the global banking industry, and it continues to grow. And banks like Amalgamated, together with a number of peers, have developed these guidelines that set criteria and guide rails for how to set targets that protects against this kind of thing. And so I think if we have banks that are setting credible targets in line with the Net Zero Banking Alliance, for example, you then are able to ensure that we don't go down that route, and we don't have to find out what would happen. So I would approach it from that perspective.
I think I'd like to add to that, and this may also be my magic wand answer, which is, at Amalgamated, we've become experts in a niche area of solar financing and PACE investments. If I had a magic wand, I'd like every financial institution to figure out which area they want to innovate in. So this is quite a practical answer, not the broader one. But I think this comes to life for us because we've discovered this niche that we actually can make a difference and have impact in. And by developing our expertise and learning, and there is some, there's some test and learn involved. There could be risk as you move along that curve, but as you become a deeper expert in a particular area of financing, you then, it's not a competitive situation, I don't believe. I believe it's something where we all help each other as that occurs. And you can mitigate the risk because you've developed the knowledge that's required. And that innovation, which could occur in one place, gets exported to others. So I think if I had a magic wand, it would be that we all do that we all lean in where we can and where we have opportunities. For us, frankly, I'm going to embarrass Ivan a little bit, but having someone like Ivan on our team who has a critical view and eye toward many of the opportunities that come forward is extremely helpful. Having that expertise, and I think we should develop much more of that around the industry.
Thank you very much. Thank you all for those insightful and important questions, and many thanks to our panelists for taking the time to join us and share their expertise. We're going to spend the last minute or so with Ivan to sum up our key points from today's discussion, and then we will close out and let you all get on with your day.
Thank you, Sarah Joy. Thank you, everybody, for participating and joining as part of the conversation. Two things before I get to the critical points. The first is to thank Sarah Joy and conveners who helped to put this together. And more than that, has been for the last few years a critical part of the sort of climate finance world, helping to pull together, as she said, the right people in the right places to have some of the tougher conversations. And a lot of the progress we've made has come because of the work of conveners.org. And the other is our friends and colleagues at Guidehouse. They've worked with us both in our target setting and in our PCAP measurement, but they also are provide the secretariat for the Partnership for Carbon Accounting Financials. And their, I think, incredible technical expertise and their even-handedness, a very Dutch personality or character that runs throughout part of the company, has been really important for the banking community to come together and work together in a kind of trusted space. And so I think both the Guidehouse and the conveners, a huge thanks. In terms of the last points here, our targets are science-based. They are premised on policy. So we will not be able to achieve this either at Amalgamated or within the banking sector if there aren't real economy policies, such as the Build Back Better agenda and a lot more at different levels. If those things don't happen, the whole thing won't work. Offsets, as you've heard a lot about here, have to be handled with extreme care, and that the principal goal here is about emissions reductions. We're very proud that we have a target that is an absolute emissions target. We think that is the right approach. And then finally, I think we've heard a lot about how, as I keep harping on, this is going to be difficult, but that there are opportunities here. There are opportunities through working together. There are opportunities through collaboration and through standard setting. And I'm particularly excited to see where this goes following the conference here in Glasgow, as we think about what the next just couple of years are going to mean as we work to hit our near-term 2030 targets. So thank you, everybody, for joining, and appreciate all of your work and participation.
Thank you all very much. And just a last note that if you are interested in more in-depth information about the amalgamated target setting process and the targets themselves, the full report is available on their website, and I would encourage you to check it out. Thanks again for your time, and we hope you have a wonderful rest of your day.
Thank you.